swap button when we're looking at the coin details or token details tab for the virtual token. I'm going to go all of it, but first we want to make sure that we're going to swap into USDC on base. You can see the little base icon there. Hit max, and there's going to be a small fee here, and at times a little bit of slippage depending on what you're trading. So with ETH, less so. Some of these smaller market cap tokens, some of the stuff like virtual and others, maybe a little bit less liquidity. But we'll do this swap here, and we're going to turn the virtual token into USDC. I think we have some USDC in here as well. So we'll do a pool that's a little bit bigger than probably 250. It's just for example. Mm-hmm. So there's our swap.
Did you make enough in fees to cover your losses from going long virtuals?
No, not at all. The whole thing just absolutely blew up. I put the pool on. The market went down 80%. The fees that it generated were in both ETH and virtual, and I think it's good for everybody to understand that this is obviously not risk-free, especially when you're trading some of these more volatile tokens. But no, the fees that we did have also went down 80%, right? Because that's important to realize that when you're providing liquidity, the rewards or the yield that you're generating is going to be in the underlying tokens that you're providing liquidity around. So in the event that you're providing ETH USDC liquidity, you're going to generate rewards or fees, however you want to think about it.
Do you want to show it? Can we pull up the browser version of a pool so people can see?
Yes, I don't have any that are live in the browser right now, so gotcha. We'll hopefully be able to show it, and we'll come back to this in the next week or so. But you're going to receive the fees in both the tokens that you're providing liquidity around. So when you're doing ETH USDC, you're going to get fees in ETH and USDC, and obviously the USDC isn't going to change. There's no price change like there is with Ethereum. In the case of the virtual ETH pool, you get virtual token as the reward and ETH as the reward, and both have gone down substantially. Virtual more than ETH, but again, ETH's gone down quite a bit. I think I've got it down 40% in the last 3 months. So there's some volatility here, but with that volatility, you can generate some fees if there's a lot of trading activity. So it looks like our USDC balance has updated here. You can see that virtual balance. It was about 243 or 246, whatever it was. That's gone away. We've got $300 worth of USDC, which, you know what? We'll just swap this in half. So we'll have a $300 pool, and we will we'll turn half of it into ETH here. So we're going to do one more swap. And once that updates, we'll go back to the DeFi browser, we'll create the pool and walk through that process. So one more swap here, our $300 in USDC. We're going to swap 150 of that into ETH. So we want to make sure that we are on ETH on the base network. And we're going to do the swap. It's not instant like I think most people are used to when you're trading on a brokerage platform like tastytrade. But this is all 100% on-chain, no intermediaries. It is going to take a second here to load, but once that's done, we will be able to put that pool on.
Where's everybody in chat? Do you guys understand liquidity pools? Like conceptually? I'm just curious where everybody's at while you get this set up.
Yeah, where's the chat at?
Where are we at?
Oh, slow day today. Everyone is just, I guess, Jerome Powell and the Federal Reserve exhausted everyone.
That'll happen.
Yeah. Or you get put to sleep, one of the two. I guess the same result at the end of it. You could see now we've got Ethereum, $192 worth of that on base, and we've got $153 worth of USDC. That's enough to work with. We'll target a $300 pool here. So let's jump back to the DeFi tab and let's have some fun. It dropped my connection. We got to fix this.
You fix that.
Yeah.
Paul Haman says no. So I think it's a cool opportunity to explain a liquidity pool as a concept. Like in traditional finance, something has to provide liquidity, okay? In DeFi, because it's decentralized, we provide liquidity. There's no centralized bank or anything with a pool of any of these assets.
That's exactly right. there's no central limit order book, and instead you just have a pool and you have a single price. So it's a little bit different, but the liquidity that facilitates the trading, whether you, in this case, with USDC and ETH, you want to buy ETH with USDC, or you want to buy USDC with ETH, you can think about that as just selling ETH for dollars. There needs to be liquidity to be able to do that, right? If I have ETH and I want dollars, there have to be dollars that are available. That's where the pools come in, but the capital that's in these pools, the assets in these pools, can be provided by anybody. It's permissionless, it's decentralized, as you mentioned. So you don't have to, or you're not necessarily competing with, or you don't have to be a large kind of financial institution in the traditional sense. You're going to see here, we're going to provide liquidity with $300 worth of assets.
And collect fees on those trades within the range. So when we say, oh, it's out of range, when you initially set up the pool, you decide, I'm going to provide liquidity between this amount and this amount. And so any activity in between these amounts, you earn the fees on that. That's the benefit. We've got some questions in chat. So the benefit is you're making your money work for you. You're acting as the bank, if that's, a simple way of putting it.
Yeah, the way that I like to think about it is that you are, in a way, running your own brokerage firm 24/7 on the blockchain. Mm-hmm. You're implicitly short volatility and you want trading activity, high volumes. When that occurs and people are trading on this exchange and your liquidity is being used to facilitate those transactions and that trading activity, instead of the fee or the commission that would normally go to an exchange or to a brokerage, that's going to go to the users that are providing liquidity. And that's where the yield is generated. And that is going to be paid in either ETH or USDC in this case, because that's the pool we're going to set up. So let's go back to the platform here and let's just create that position really quickly. So you saw initially we had a pool with the virtual token and with ETH. No longer. We don't have any pools. You can view your closed pools if you want to, but no reason for us to do that here. Instead, we want to create a new position or a new pool. So I'm going to click on new. And then the first thing that we need to do is select whether we want to participate on Uniswap v3, v4. V4 is the most recent update or version to Uniswap. There's some interesting advances or kind of improvements to it, some features, I suppose, something called hooks. We're not going to talk about that right now. More liquidity for what we want to do has, at least up until now, been on v3. So we're going to just change it to v3. And then we're going to do this on the base network. So we want to make sure that we are using our ETH that's on base and not our ETH that's on the Ethereum layer 1. And then that's going to be the same thing for the USDC side. So we're going to take that USDC that you can see has that base icon there in blue, and we're going to use that. The next thing that it's going to ask us for is the fee tier. So there are different pools that are going to have associated fees with them that the trader, the swapper, the end user is going to pay. We're going to use the 5 basis point fee tier because that's where there's typically been more activity recently. And I don't know if we'll have time today, but we could show how to view all of this through the Uniswap dashboard. But we'll use the 5% fee tier, and then we're going to click continue. And now at this point, you need to select the range that you want to provide liquidity within. And so you can define a specific range, or you can provide liquidity across the whole thing. You can see up here at the top, set price range, full range, or custom range. What I like to do, Shelly, is use the expected moves from the dashboard and the spot price and implied volatility that we use as an input to calculate my range. It's not going to be perfect, but when we were looking at this previously, our range was about 1850 to 2200 or so. Let's do that. It could be 1900, it could be 2200. We probably have a little bit more of one token versus the other. So we're going to have to kind of work with this a little bit. But let's go custom range. And then it's easy to do this too when you have a little bit of a bigger window on the browser. But you can also set your range up just based on this drag and drop functionality that you have. So you can see I'm just doing this with my finger here, with my thumb. But maybe we want to come in here and we'll set that at about 2,000 or so. Or no, that's the current price. Excuse me, 2,038, and we can move this around. When we do that, we'll get those resulting prices down here. So what did I say? 1820 is our minimum price. We'll move that up a little bit. Let's just go about 1,900. See if we can get it there. Probably takes a second to adjust. And again, yeah, apologies. Sometimes a little bit easier to do.
It looks like you can toggle the numbers with the plus and minus at the bottom too.
You can, yeah. So you can adjust it by clicking the plus or minus, and you can also come in here and you can type in a value. But let's go 18, 20, 21, 06 on the upside, just as an example here for how to set this up. And then we've got to decide how much of each one of these that we want to use. We want to come in with about 50-50. And so in some cases, I'm not going to have enough of one versus the other. If I went max here on the ETH side, you can see that given the current range that I set up, I don't have enough USDC for that range. So what you want to make sure is that you're pretty close on either side, almost equal distance away. Let me see if I can adjust that a little bit more so that we're...
While you're doing that, I'm going to answer or address a couple of questions here. Kyle is asking, what's the benefit versus keeping it in USDC? Well, to earn fees on the trades that is using your liquidity. And then are all fees the same, or does it depend on what you're trading? It does depend on what you're providing liquidity for. So if you have two tokens, in this case it's ETH and USDC, your fees will be in ETH and USDC. And then, is it the same as running an ETH validator node yourself, but sharing in the requirements and costs?
No.
Okay.
No, that is going to be really staking. This is, and sometimes we use this broader staking term, but this is providing liquidity to a decentralized exchange to facilitate the exchange, the trading activity. And so you are going to generate yield, and that's the reason why you'd want to do this. It's going to be volatile, but again, it's kind of like you're running your own business, your brokerage on the blockchain with your capital. So you're using these assets to facilitate this process. It's how decentralized exchange works. You benefit because you're going to be able to generate fees or rewards for putting your capital into this system. You could just hold USDC and you can probably get 4% or so in some places on that. We'll show the yields that you can generate on an annualized basis. They're going to fluctuate and certainly going to be related to whether ETH is going up or down in price. But this can be a bit more lucrative than just sitting in US dollars. But sitting in US dollars is it's risk-free when you look at investing in US treasuries or lending money to the US government versus here, there's a volatility premium that's associated with it. And so I've just adjusted this range so that we can get both of our values closer to one another. We said we wanted to start this with about $300 worth of capital. So we'll come in here and our price is going to be $18.50 on the downside, $22.44 on the upside. Let's just review this really quickly before we run out of time so we can show everybody what it looks like. We're going to create the pool. I'm going to have to sign the transaction here in just a second. And then once that's done, it'll pop up here in just a moment and our pool will be live. So here's our pool. This is the annualized percentage return that we're talking about. This is going to be variable. It's going to change based on a lot of different factors. But right now, it's at 50%. That's if you were static at this level, nothing changed over the next year, you would expect to generate a 50% return on this. Now, obviously, that's not realistic. We will check back in on this and update everybody. But if we jump back into this, here is our pool again. There's $304.05 of liquidity. You can see it's about 50-50 ETH and USDC. As the price of ETH goes up, this pool will be selling ETH because that means that people are coming into the exchange. They're buying ETH, so they're putting USDC into the pool. They're taking ETH out. There's going to be less ETH in our pool, more USDC. We will get into the details as to how and why these things fluctuate. We haven't quite made a penny yet, but you can see that there are already fees being generated. We will check back in on this again next week, and you'll see how much that's changed. It is contingent on trading activity and whether or not the price of ETH goes up or down. But I think everyone's going to enjoy what we're able to do with this, even with a small amount of money, with $304 to start with. Mm-hmm. So we will check back in. I know we're running out of time here today, but
I've got one last question.
Yes.
Is staking equal to posting?
I don't know what is meant by posting. Staking is, we have a proof of stake blockchain that uses a proof of stake consensus mechanism, something like Ethereum. And we are putting up Ethereum to provide security to to the blockchain network in terms of how it works to validate transactions, and then we're rewarded as a result in ETH for doing that. In many ways, I suppose you could think of if ETH is the underlying currency, staking is in effect lending money to the system, or if dollars are the underlying currency, you're lending dollars in terms of treasuries when the U.S. borrows, and you're returning, in some cases, you're returning, obviously, U.S. dollars there. So it's kind of similar in that sense. You're lending money to a system, and you are receiving a reward in that underlying currency. Not the best example of or explanation of staking, but providing liquidity and staking are not the same thing in that sense. So that is our liquidity pool. We will check back again on this. That's going to do it for our show. Victor is up next with the price of truth. We'll be back next week on Monday. But again, thank you everyone for watching. If you're getting into this yourselves and you have some questions around this, obviously hit us up in the Tasty Crypto Discord. Hit us up on Twitter or email support@tastycrypto.com, and we're happy to help out. But that's going to do it for our show. I'm Ryan.
I'm Shelly.
Peace.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Nicky Bat, University of Kansas. Number 20 because that's how many underlines are in my portfolio.
Rick Welch, Illinois Institute of Technology. Number 23, because I'm trained 23 hours a day.
Dr. Data, Louisiana State University. Number, square root of 1 over 365, because that's the square root of time for 1 day, which is multiplied times the stock price, multiplied times the implied volatility, which gets you the projected stock price for 1 day.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
What happens when two titans of trading come together to harness the power of their prowess? Let's watch these two master the art of the noble sport boxing. Wow, look at those geriatric thumbs go. Someone had an extra dose of fibre this morning. Like a flutter of fills, it's definitely fists of plastic fury over here. And I'm spent. Well, lucky for us, Tom and TP are better at writing than they are almost anything else. Subscribe to Tasty Live Cherry Bomb to get piping hot takes on the market delivered right to your inbox. Sign up at tastylive.com/newsletters.
Tom versus Tony. Round 1. Trade. Massive volume. Killer trade. Surplus. Shoot. The fall. Volatility boost. Killer trade. Resistance. Straddle support. Order sold. You win.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it is Wednesday. Wacky Wednesday around here. March 19th or so, they say, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. And good God, there are a lot of incentives to evaluate. Before we go one damn step further, we should acknowledge we've got the GOAT in the house, the one, the only, the head of global macro here at Tasty Live, and quite frankly, the Roman warrior you want on your side when you're going into FOMC Wednesday. I'm talking, of course, about Ilya Spivak. Ilya, how are you, my friend?
Good. I don't think I've ever given, especially my Soviet Jewish extraction, earned the title of Roman warrior of all things. But I will take it. It's been an interesting day. I'm kind of happy that I didn't get bared up into this Fed policy announcement. And I'm kind of happy that the price action seems to be doing what you might expect, which tells me that maybe we're reading the tea leaves reasonably well.
I think so. But, you always like to do this. You always try to get into the wham, bam, thank you, ma'am, straight into the, meat and potato. I'm the guy I like to build a little rapport at the open of the show, Ilya. You know what I mean? Tell me.
It's 5
tell me
p.m.
about
Central
yourself.
here. I've been listening
tell
to
me
Powell
about your
for
aches and your
hours.
pains or new music you listen to. You know what I mean?
Oh, here's a plug. Here is a plug, by the way.
Here we go.
Here is a plug.
Here we go.
If you are not listening to one A1 Beans with a Z, hailing from San Diego, California, do yourself a favor.
That's the last time I ask you about your own personal business. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile application. But if you want to be part of this little chat box in the middle of your screen, there's only one place to do it. Head on over to Tasty Live's YouTube segment and start bashing your face into the keyboard, your metacarpals, phalanges, whatever will work. Just monkey fist it if you have to. And spoof the Google algorithm into putting us in front of as many people as possible. Let's start the deprogramming today. Save as many people as we can. Ilya Spivak, without further ado, it of course is the big news of the day. Jay Powell brought back the T word. We'll get back to that. The S&P was up 1% on the day. Nasdaq was up 1.3%. Oh my God, bro! It was 2:30 in the morning. When that came on. So I'm laying in bed. I'm trying to be quiet. I got my headphones in. I'm listening to the press conference. They asked him about tariffs. And he says the tariff inflation is going to be transitory. I took my headphones off. I'm like, I can't do this.
I'm going back to bed. I've heard enough.
Yeah, I had to catch up later. I was so infuriated in the middle of the night. I'm like, I cannot do this. I got to regroup and come back. The Russell up 1.5%. It was the outperformer on the day. Ilya Spivak, go wherever you want to here. Open-ended question. You go straight to the FOMC if you want to, or we can talk price action first before we sort of unpack the SEP and the Q&A, the conference, everything we saw today.
Well, I think the price action really tells you what the markets thought of all those things that we're going to break down here. And I think the upshot was pretty straightforward. My playbook, as you know, going into this was the markets decided at some point last week, if you looked at Fed funds futures shortly after the administration really started to come out there and say, yes, we see the stock sell off. No, we're not concerned. No, we're not going to change anything that we're doing on its basis. I think the market said, all right, fine. If you wanted some sort of market discipline dynamic with the White House, you're not going to get it. So what's the relief valve? Well, typically, when the market is in some sort of state of consternation and fiscal policy isn't complying, for example, in the wake of the 2008 crisis, where we had the sequester and all this fighting about the debt ceiling and an incoherent fiscal situation where the two sides couldn't get along, the markets looked at the Fed and said, you come save us. You come give us cheap money to make all of this digestible. And some point middle of last week, the market seemed to look at the Fed and go, okay, your move. These guys don't want to listen to us, or we're not going to get a change of course from them. We're concerned. You're going to have to come and tell us something good. We want to feel seen here. And so you saw that in Fed funds futures. My thinking was the market was going to run up stocks into the Fed meeting. And then when the Fed gave them just talk and no action, which is sort of what the Fed did, then I will take your consternation in due course, sir. All of that would be disappointing because the Fed didn't adjust the goalposts formally. And as it turned out, the markets didn't rally into the Fed. They just stopped falling, but they ultimately couldn't build any momentum. And the reason I didn't think that was ominous was because I thought, well, that actually lowers the bar. The Fed can do less, and the markets still have all of their sigh of relief to exhale, as it were. And so when the Fed came out and basically told the markets, we see you. Uncertainty is up. We don't know what the implications of the tariffs, but we know, as Powell said in the press conference, that usually it means a little bit more inflation. Usually it means a little less growth. We don't know for how long. We don't know how much, but that's what's reflected in the forecasts. And by the way, the forecasts reflect a lot more policy uncertainty from officials. Like, they're making these forecasts, but they're not sure about them to a much greater extent now, versus, let's say, December. And so the markets in that sense feel seen.
Just to unpack that a little bit, the way that you can tell that there's less confidence in the forecast is how, Ilya?
Well, they publish it. So they actually give you charts on this, and they tell you, here's a handy dandy chart here. That's part of the surveying. So we're going to ask all of the FOMC participants, what's your expectations for GDP, for unemployment, for inflation, both core and not, for the path of the Fed funds rate, and then we're going to ask you, how sure are you? And which way are your risks tilting? And when you look at then the responses, and they grade them on some sort of scale, right? Like, okay, are you on a scale of 1 to 10? Are you, let's say, are you more concerned, less concerned, more certain, less certain, more certain about this, more certain about that? The risks to inflation are tilting in this surveying higher, the risks to growth lower, and the level of conviction is down across the board. And what Powell is saying here seemingly is, we see you. We also notice that the survey data is starting to look scary, be it business confidence or consumer confidence. And he said this in the press conference over and over again. This is soft data. We haven't seen it in the hard data. I would argue that we have in CPI, in particular in the internals, but they want more. Okay, fine. So it seems like what they need is a bad NFP report to really get freaked out about. But for the moment, they're like, okay, well, you're uncertain, we're uncertain, nobody knows. Why would we go do stuff? But we are watching. We do see you. We will act. We're not going to let this thing go off the rails. And I think that was enough for markets, even though the actual targets for easing didn't change and nothing really moved around at the brass tacks level. The tone, the messaging was, I think, what the markets wanted to hear, and they came in prepared to embrace it. Stocks go higher, yields go down, dollar falls.
So just in case somebody needs sort of the cliff notes on what happened today, the Federal Reserve did not move interest rates. They held steady. They also put out a new summary of economic projections. Actually, they didn't move interest rates. They decreased their amount of quantitative tightening from about 25 billion down to 5 billion. Do I got that right?
Just on treasuries. They didn't touch the agency's papers stuff, but yes, they are now going. And what Powell said essentially is, the reason we're doing this is we want to do it slower. So we want to get to the same place on the balance sheet, but we want to get there in about double the time, he guesstimated. So that's ostensibly what's going on here. But
sure.
But listen, if you had to take one headline and say the Fed slowed quantitative tightening from 25 billion runoff a month to 5 billion runoff a month on Treasury securities, knowing nothing else, dovish or hawkish? Dovish.
Correct.
That's it. Like, yes, the upshot, dovish. Ostensibly not a big deal, not anything that's going to like spook the children, as it were, but the bias is dovish.
Yeah, I think so. There's a couple things. Again, the summary here is no move to the Fed funds rates. They decrease the amount of quantitative tightening, and they put out a new summary of economic projections. And in the summary of economic projections, shout out to Chris, he almost guessed this exactly right. They moved GDP down to 1.7% in 2025. They also moved 2026 and 2027 lower to 1.8%. All those numbers are right about at trend, if not just below. They moved up unemployment for 2025. And I don't think either of us saw these. They significantly increased their inflation projections for 2025 in both headlined and in core, and they bumped them up in 2026 as well, effectively saying, like, I don't know. I think the market interpreted that as adding in some margin of safety for the potential impact of tariffs. But I just, I've got my own opinion there. I'll bring up later. And then the Fed funds targets didn't really change, or the projections didn't really change for 2025, 2026, and 2027, which somewhat surprised me that you could move the inflation targets and not necessarily do anything about your Fed funds rate, which effectively starts to scream out transitory. And one of the funny things that happened during the conference, they asked him about tariffs and they asked him about the increased inflation projection, and he said that he would expect it to be transitory, and I fell out of my seat. But I think a lot of people are making a lot about the idea that growth is coming down in these projections, inflation is going up. That doesn't mean it's stagflation, but it does create what is called stagflationary conditions, meaning growth is decelerating while inflation is accelerating. Your thoughts, man? Your thoughts on just that piece alone that people are making a lot about on Twitter and financial media, that the stagflationary conditions. If gold at 3,000 didn't tell you that was the environment we were in, you needed a piece of paper to tell you, but whatever. Ilya, what are your thoughts on that?
Well, I mean, all this does is it basically reiterates the obvious. I mean, why are the markets so afraid? Because when we came out with the S&P Global PMI numbers, let's say that's business confidence, quote unquote, very good business confidence, very potent data, very closely aligned with GDP. And we often look at it as a GDP forerunner, but in its essence, it's a business confidence survey. So business confidence shows businesses are afraid, and they're afraid in the wrong sector, right? The tariffs are a goods sector thing. And what the PMIs show you is that the service sector is freaking out. That tells you that the uncertainty isn't just about the policy itself. It's about the way that things are occurring. And just a general kind of pall on business activity from looking at what is going on with the new administration and going, well, we knew the tariffs were coming in November. We knew that some sort of fiscal hit to expenditure was coming, and that maybe he was going to get balanced with tax cuts. We knew all of this. The president ran on this. The president got elected on this. This is not surprising. The markets don't really move on this until it shows up in business confidence and later in consumer confidence with inflation expectations there surging. And that's when the markets go, wait, this isn't just optics now. Now people are responding and consumer and business behavior is changing as a consequence of this. Now we're concerned. That's what this sell-off in the S&P from late February, sort of second half of February, that's what it's been all about. Stagflationary tendencies are what this is from the very beginning. Inflation expectations going up, growth expectations weakening, and ostensibly the Fed going, no big deal. And what the Fed did here was it said, whoa, we see you. We are also concerned. We don't want to get it wrong. We don't see a reason to have our head on fire right now, but we do see you. We're not ignoring it. Because the message from the administration is they're ignoring it. They don't care. This is fine. So I think that was the important signal here. I don't think Powell said that the tariff inflation is transitory. I think he said it could be transitory. And that's an important difference because he obviously doesn't want to get into a stupid fight with the White House, right? Play stupid games, win stupid prizes, as it were. And the White House has said, the Treasury Secretary has said repeatedly, the tariffs are a one-time adjustment. There'll be an adjustment. Businesses will rebalance. Things will continue. Obviously, that's already something that the markets are questioning because we keep adjusting the tariffs back and forth. So how much of a one-time adjustment is it? But Powell said, you know what? Maybe it is a one-time adjustment. Maybe it's not. Right now,
no, he said their base case is that it's transitory. That's what.
Well, right, because I think he has to say that. Because what that followed was typically tariffs mean this and typically tariffs mean that. So that's what we have in the SEP.
I really respect you, Ilya, and I think in this particular case, he didn't have to say that. He could have said what he says about all the rest of the unknown.
He didn't have to use the T word. That's for
yeah. He could have said, we'll see. We have, we don't have enough information. We'll let the data. He could have said so many other things than starting to wear a position again. He wore a position in 2022.
The wording was wrong. I agree.
No, that's what I'm saying.
The wording.
He's wearing wrong. He now started to wear a position.
That word has baggage.
I don't think that's a very smart thing to do.
I agree. The word has damage. The decision not to contradict the Treasury Secretary and say our base case scenario is the Treasury knows what it's doing is not a controversial thing, and it makes sense because you don't want to have a fight right now in this environment about the role of the Fed and the Fed fighting with the president and fighting with the Treasury Secretary. Strategically, if you're the Fed, not even just for political reasons, but if you're the Fed, you don't want to compound any kind of issue you may be seeing by having the monetary and fiscal policy authorities get into a fight. So it makes sense that you give the Treasury the benefit of the doubt until you know. But to your point, the transitory word is a loaded word. And you could have said it 1,000 ways without using it. And the message when you use that word isn't one that's confidence building.
Yeah, to say the least.
Although the markets liked it, in fairness. The markets liked it.
Because they don't give a shit. I mean, like you use language like that. It's like what's in the SEP, and you're telling, okay, they dropped QT down to $5 billion. Okay, I got it. Say no more.
The markets responded as you might expect, which is why I think my view here is that there's more to go up, but ultimately the trend is still down.
I agree. I think like the VIX term structure went into just normalized today, total contango on the flip side of FOMC, meaning it seems like that was the last little bit of sort of consternation from the marketplace to get back to a more normalized structure. We're still elevated in terms of volatility at 19 and change or something. But we are normalized, and I actually agree with you. Some part of me is sort of scratching my head about what's going on with bonds. I do know you got two opposing forces there, because what I think they did was they just told you what bonds and gold have already told you. If you look at the way that the yield curve has moved, you can go, okay, there's a real scare here, and term premium. When you look at inflation scare or sticky inflation at 2.5% or above, that hasn't gone away. So you just look at the curve, you go, okay, there's a growth scare here, and there's still sticky inflation being reflected in the curve. And then you look at gold and you go, well, that's telling you that's probably not a good sign. That's just it's got stagflation written all over it. And that's kind of what the SEP put in front of everybody. Lower growth expectations, sticky inflation, and we're not going to do anything. That's the biggest thing. Like, we haven't changed our Fed funds projection. We're still at 2 cuts. So let me ask you that, Ilya. Like, the staying at 3.9% in the Fed funds, still sort of projecting out 2 cuts, which is less than I think where the market had them coming into today. If I'm not mistaken, the market was about 3 cuts, at times flirting with 4. Was that surprising at all to you? And do you think, how do you think this changes how the Fed manages policy for the rest of the year?
And I think if you look at the upshot, right, you're looking at today, 62 basis points for this year and 33 basis points for next year. So you're looking at 2 with a possibility, about a 50-50 chance of a third this year, and you're looking at 1 next year. So altogether, you're kind of back to where you were, let's say, two weeks ago, maybe 3 weeks ago.
Mm-hmm.
We got as far out as 120 cumulative basis points, which obviously started to flirt with the idea that the market was getting more dovish than the Fed. We're off that now. The markets obviously are quite a ways away from where they were, let's say, a month ago. A month ago, they were way less dovish than the Fed. The Fed in December said 100 basis points. Mid-February, the market was at 50 through the end of next year. So the market thought growth is fine. You don't need to cut a lot. Relax. Obviously, since then, market pricing has moved closer to where the Fed is. I mean, about 60 for this year, about 30 and change for next year. That's 90 and change. That's basically the Fed forecast, which is why I think the markets didn't give the Fed anything to run away on. They're basically in line. It's just the market is a little bit more urgent. It wants more of the cuts up front and less next year because of this concern. But at this point, the markets and the Fed are close to being in line. It's just the markets want this sooner. I think they were happy that they were heard. And the next thing that has to happen is the Fed, they don't meet in April. Next time they meet is May. There's quite a long period of time here between now and then. All kinds of economic data is going to come out, including hard data. If what we've seen so far continues to occur, you're going to invariably start to see it show up in big figures, in things like more drop-off in retail sales, more drop-off in industrial production, more drop-off in consumer sentiment numbers, business sentiment numbers, more internal weakness in the CPI report, which already is telling you that the part that's disinflating is core services, which is about growth. All of the shading on CPI is the, drumroll, transitory part, the part that the Fed doesn't care about. All of the shading that keeps CPI relatively elevated is the statistical rollover of negative contributions from energy and goods last year that's now becoming less negative and not negative. All it really is rebasing in year-on-year numbers. It's not anything to scream about. The real issue, maybe 2.5 percentage points of our close to 3 percentage point inflation rate in the US is core services. And the weakness is there. That's what's concerning. In the last set of numbers, it fell by the most in a long time for a single month. And so that's really the issue. As you start to get more hard data, those recession fears build and the markets start to yell at the Fed again, because now it's like, okay, well, you said you do stuff. Here we go, buddy. Strap in. We're going to want you to give us something concrete now. So if that plays out, so I went into this Fed policy announcement not sure, so knowing the Fed's going to have to acknowledge something, but not sure if the markets will think that their acknowledgement is enough. And so I didn't have a position in stocks. I got out of my shorts last week. So last week, like on Tuesday, I think. So for me, I was just waiting to see how much of a bounce we'll get. I think we can have more of a bounce now. The one thing that, or the two things in there related that I did have on, because I thought there was no way that the Fed doesn't somehow end up striking a dovish tone either directly or by proxy, where if they're too resistant, the market goes, you're out of your mind. Let's put more easing in the back of the curve because you all will come around. Either way, I thought the long end goes higher and longer end yields weaken and the dollar weakens. And that's what this was ultimately. So that's worked. I'm looking now probably for those moves to sort of, we'll see if they have immediate continuation, but for stocks, I think you could go higher before this turns. But as those recession fears and the hard data come in, I think you get back to stocks going lower, so they'll give you an opportunity to sell them from higher levels.
Yeah. I'm not quite sure what to think about stocks. I was obviously leaning long, and got lucky today a little bit. But I don't know. There's a part of me that goes, how should I think about QT? How should I think about moving that down from 25 to 5? How much ointment is that for a market that's been battered up and bruised a little bit by growth expectations? And is that enough? How much, you get what I'm saying? Like, how much ointment is that for the market? Or is that really just, in a way, sort of, it's a little bit of ointment for the long end? Because I'm scratching my head thinking, like, why, I'm trying to understand why the long end did what it did today. And so some part of me goes, what just happened today, is it of any consequence, real material consequence for equities? Or is it really just, it's a mechanism, I know it adds liquidity, but it's a mechanism to sort of control long end yields right now? Maybe the answer is both. I don't have a strong bead on this. So it's not like I'm taking crazy equity risk. I'm still quite cautious there. I still don't love a long or short position in bonds either. So I'm just sticking to what I've been doing, which is like just buying bombed out materials and trying to keep my portfolio delta in a manageable level. Let me ask you, Ilya, on the flip side of what happened today, given the additional vol crush, given the move, the teeny tiny move in the curve, not much happened today. I mean, bonds did lift just a little bit, but not much happened. A little bit of a risk rally.
Most of it was at the front end for bonds. ZT, if you take a look at that, had a more convincing move than did ZB or ZN. But and that sort of tells you that the markets, again, didn't really think it's more easing that they're seeing versus what the Fed has. They just think it should come sooner.
Risk. What do you do with your risk here, given we're on the other side of this event risk? What are you going to do? How are you going to position?
I'm keeping my short dollar exposure. One of the standouts today in the wake of all of this, because of the kind of dovish veneer that the markets perceived, was the yen surged. That's working with my exposure. I'm long that. The Aussie dollar was something I added to, because and I did that actually going into the Fed, so I got more short dollars against the Aussie. It seemed to have found a little bit of intermediate support on a pullback, so I thought the risk reward there made sense. And all around the dollar today, Aussie, pound, euro, what you see is a dollar that was down, then a dollar that came back up going into the Fed. And once the Fed came out, it gave up all of those gains, all of its intraday rebound. So the market was tilting into the Fed on the long side of dollars, and then gave it all up as the Fed gave them this sort of more dovish, flavored sort of thing. And so for me, I keep short dollars. I think that's going to keep working. I keep long the long end of the curve. I think more easing will come into the picture downwind, and I think that's going to be helpful. And Besides that, I'm looking at stocks and I'm sharpening my knives, but I'm not doing anything because I don't think that we're done with this bounce. I don't want to be a buyer of this bounce because I think the trend is down, and trading a counter trend reversal when now with the Fed out of the way, the primary variable is headlines from the White House. That's a very difficult thing to kind of benchmark against and say, okay, well, I have a good feeling or a good sense for what this might be. Who knows? I would rather just wait for stocks to get back to levels that appear attractive to re-enter short. And there, I'm just being a third grade technician, taking a crayon essentially and drawing it across the chart for horizontal lines and saying, okay, well, reasonably, where could the S&P bounce? 5,800-ish. Where could NASDAQ bounce? 20,000, maybe as far as 600 or so. Where could Russell bounce? 2,200-ish. So those are sort of the big lines in the sand, the undersides of the range from early December through the beginning of this sell-off, where you had former support that this sell-off has taken out. So I can see us correcting back to those inflection points. I would be looking for signs of exhaustion there to get short again. I don't think this down move is over by half.
Do you think I'm going to ask I might regret asking this question. What worse news can come out from the administration at this point in the very short term?
I think the issue hasn't really been whether the news is good or bad, because that becomes a subjective political opinion. I think from the market's perspective, the problem has been that the news is inconsistent in the sense that there are policy reversals frequently and policy revisions frequently because actions are being taken and then they're being pushed back. So, for example, you fire a bunch of federal workers, now the courts have mandated you to rehire them back. And you're doing it. You're actually
you think
following.
The markets care? You think the markets care about that?
Yes, I do. And I don't think the markets care about the substance of the decision. I think they care about how incongruous the actions are. They're on, they're off. We're doing it, we're not doing it. We did it, but now we have to take it back. I think what the markets would love is for the deregulation and the tax cuts to be front and center. I think that's what they want. Because I think the markets uniformly love that. And that's what motivated them to like the election in the fourth quarter of last year. Because they looked at it and said, well, the tariffs won't amount to much. They're a negotiating tactic. We know this from the first administration. The intention seems to be not to break, for example, the USMCA, but actually to make it bigger, to make a bigger free trade zone, not a smaller one, and basically to use force to cajole Canada and Mexico into including more goods in the USMCA, to get Europe to rearm, and if necessary, to get them to rearm by scaring them to death. That's obviously working. To get the Middle East settled, if necessary, by coercion. It hasn't worked.
I don't think anybody with real money in the market sees the world that way. I think what the difficulty is handicapping the outcomes. So,
but that's exactly what I'm talking about.
No,
so if you read the
PM,
you don't have to wonder what the reasons are, because the PMIs tell you and the consumer confidence numbers tell you.
Have you read Mirren's Mar-a-Lago Accords? I think it's called A User's Guide for Redefining Global Trade, something to this extent.
No.
So in it's probably the best steelman argument for sort of the positioning of what this administration is trying to do in restructuring global trade. And I think most people, I think a lot of people, I think there's a lot of market participants who have read this thing and sort of understand the context for when you listening to Besant, for listening to Lutnick, as crazy of a character as he is, for listening to the administration and seeing it through the lens that they see the world. Again, I'm not saying that that view is correct, but I think if you read this paper and other of their policy papers, I think they're pretty clear about what they're attempting to do. Trump isn't the greatest communicator, so he's not some guy who's going to get up and tell you some very clear philosophy. And I think that's purposeful because I think he doesn't like to be locked into decisions. I think he likes the idea of flexibility, but I think that becomes problematic because people are listening to him and they don't see any clear goal. They don't see any clear strategy. And so then there's this opportunity to paint this as just a chaotic sort of go wherever the wind blows type situation. And I have felt, again, whether I agree with the direction or not, or the tactics, there actually is a cohesive strategy to this, and there's a desired outcome to this. And I think that paper by Mirren is for anyone who hasn't read it and you think this is just crazy, out of control lunacy, I think if you do read the paper, I think you'll get a better handle on the steel man of what they're trying to accomplish. So I would just put that out there for the audience more than anything. But dude, like you and I, we don't give a shit about, you fired somebody and you hired them back. Like it informs your political point of view and whether or not this person's like credible or whether or not they're thinking strategically. But bro, like I'm not going to buy or sell the S&P because of stuff like that. And neither are you.
I think we're talking past each other here because I think what you're saying is that there is a method to the madness, and I don't think the markets disagreed with that idea. I think it would be wrong to confuse the market's problem with what's going on here with them saying, A, these are necessarily bad policies, because the markets knew these would be the policies in November, if not earlier. That much is known. And they were perfectly steady through that. It didn't bother them. I think it would likewise be wrong to say that the markets don't care about the execution of these policies. It isn't about you hire or rehire this or that person in terms of the impact of that person. It's about an incoherence in execution. It's about the markets looking and saying,
I just don't agree. I hear what you're saying. I just don't agree. I think what they're trying to do is incredibly risky, and it increases the potential range of outcomes. And given that large range of outcomes, you have to discount a wider range of possibilities here.
I mean, that's fine, but
risky.
The markets don't agree with you because what you see in the price action.
You're interpreting what you think the market is saying, and I'm interpreting what I think the market is saying.
I don't think that's what I'm doing. I think what I'm doing is I'm reading the PMIs and what the business leaders surveyed for it are saying. I am reading the consumer confidence reports and what the people being polled there are saying. I see the political affiliation breakdown, by the way, also in those consumer confidence numbers, and that's its own story, because when they take these surveys, they ask people, do you affiliate this way, do you affiliate that way, and then they use that in the stats to kind of give a sense for whether the direction in the numbers is skewed partisan, not skewed partisan, whether when you hold that constant, if there's consistency, etc. So it's not like these surveys are coming from some sort of left-wing sources or the mainstream media, God help them, is somehow in charge of this surveying. No. When you read these surveys, you can see what people are concerned with. It's not my opinion. It's what people are being told in these surveys. And then you line it up to the price action and you say, well, the day this survey came out, this is what the market did. So it's very obvious. It's not a point of debate in my mind that what the markets are concerned with isn't the direction of the policy, it's the level of confusion around it that they perceive. This is not to say that you're wrong in saying that this is not a bug, it's a feature, and that that may very well be. I don't agree or disagree. For me, it's much simpler. Whether it's a bug or it's a feature, consumers and businesses don't like it, and the markets reflect that.
You're right. We are talking past each other. So I guess I'll do one more quick point on this because I am enjoying the discussion. But you and I, sometimes we get lost in the nuance of trying to put this dot on an I, which I love. I don't know. The audience may or may not. I agree. I agree. Here's what I'm trying to say. If you are big money in a marketplace and you have context for the actions that are being taken in the marketplace, then you will look at dislocations as opportunity. And so what I think is and that's why I kept saying big money, because the small mom and pop business, the person who goes, I don't know what the hell's going on. It's like, yeah, of course you don't. But I see a bunch of those people on the street when you talk about something as big as restructuring global trade, bro, people are not going to wrap their minds around it. Sure. And I get what you're saying on this survey and all these things, which then the uncertainty leads a business or a consumer to potentially pull back on spending. It's something that Bobby Moynihan today, by the way, said that that's not happening at the consumer level for Bank of America customers. He said they've actually increased spending 6% over where they were a year ago. So I hear what you're saying, but I guess I think what I'm saying is one level up, which is big money in a marketplace. And there is a ton of big concentrated money, cares less that Joe and Susan, a small business, can't interpret what's happening in a moment of restructuring global trade. To me, that is obvious, and that is acceptable collateral. That is going to happen. But I think any other market participant that's going, I see what's happening here. I see the attempt to restructure global trade. You might not agree with it, but you see it. And then you go, there's a lot that can go wrong here. It could go right. I see potential for it to land on the right end of the distribution curve, but there's a lot of things that can happen here and that can go wrong. Canada's got to play. Mexico's got to play. They both got to turn the tariff guns and the trade negotiation guns against China in the way that Trump wants, and he's got to win that negotiation to whatever that means. And those are a lot of big ifs. So I go, I know there's vol coming. I know there's uncertainty from Main Street or a bunch of people that can't understand what it means to restructure global trade. I take that as a given, and I know how to operate in a higher than average or higher than normal volatility regime. I know how to operate in backwardation and these types of things, but I cannot tell you with any degree of confidence how this ends and when it ends. And I think, so my distribution goes wider, but it doesn't scare me away from participating in markets. I just change how I discount these things a little bit. And so I think what you're saying,
disagree with you. Yeah.
I know you do, but that's okay. What I'm saying is it's okay.
Yeah. And I totally get what you're saying, by the way.
And
it's entirely logical.
Saying. But I see how you view markets, and I see how I view markets. And you are a bit more bottom up in your view of markets. I'm a bit more top down in my view
even
of
top
markets.
down. Even top down. I think there's a very clear inconsistency in your logic that I perceive, and that inconsistency is the S&P 500, which clearly has had the worst 4-week run since October, November 2022, and the first series of consecutive 4-week losses, of consecutive weekly losses for 4 weeks since August.
Yeah.
The
Want me to explain
notion that the S&P 500 is able to make a move like that, and the big money doesn't care, seems silly to me. The big money, of course, cares because the S&P is a huge, tremendously liquid instrument that you couldn't move around with with just a sentiment survey unless people cared about the sentiment survey. And the top in it is the day of the first PMI really putting up a red flag. It is day of February the 21st. So to me, you don't move the S&P 500 to this extent if the market doesn't care and sees some high-level, wider distribution of outcomes, which of course it does and which is of course the case. It just doesn't care because it has seen that wide distribution, or at least should have, back in November. It knew what was coming. What the markets don't like is that thing that has come, which it knew about, is now spooking real economy participants, people that spend, businesses that invest. And you can clearly see it. And if the markets didn't care, you would not have a 10% down in the S&P move in 4 weeks. But you do. So that money movement, you cannot ignore. At the end of the day, I have had a gazillion and one different macro theories proven to be wrong by the price action. At the end of the day, you have to go with the price action. Right. And to me, the price action is unmistakable here.
Right. But so again, there is a difference. And I wish I could let this go because I really want to move on to other topics. But there is a difference between correlation and causation. And I think what you do is you speak very confidently about causation. And you do that using correlation. And what I'm telling you, Ilya, is that while these things may coincide in time and you may speak confidently that they are linked, I can also tell you that, like, I think one of the potential mistakes lurking underneath the surface is sort of like misidentifying causes of volatility. That has happened to me in the past. I think in a way in 2022 I got lucky in some regards because when I look back, I think I was off a little bit on some of my reading of where volatility was coming from, which then it doesn't hurt you if you're in the right direction, but then understanding when those risks are subsiding. If you're looking over here and the market was looking over here, then you're not going to be participating when the market has changed its mind because you think the narrative or the reasons are over here. So here's the last point that I'll make is I believe the underlying economy was much weaker than I think the data which you take as gospel. I agree with you. I'm down. No,
I agree with you.
I think the underlying economy was much weaker, and I think we
would get a new. Since November.
I think you were right. I think it was for the last year. So I think we sort of pumped up. We had this fiscal impulse that helped to sort of game these numbers and make the economy feel a bit or headline a bit stronger than it actually was underlying. And I think that ran out. And I think the tariffs are not helping, but I think people should be careful about putting all of the risk that the market has experienced under one
I totally agree with you.
And saying it's all this thing and this guy, and that's what everyone's freaking out about, because I think that is missing the forest for the trees. I think it's
totally
much wider issue here. I think it's not helping. I totally
agree with you.
It's clearly a catalyst for people making a change in risk, but I think the economy was much weaker. And because a PMI shows up on a day or week or whatever, we start talking tariffs, doesn't mean that was the cause, especially because PMIs build up in the system over time. Go ahead.
I agree with you that obviously you don't get a 4-week sell-off on the – I think, interestingly enough, we actually agree. I think exactly right. Why was I bearish all of last year and fighting the market? For this reason, because the economy looked like it was due to feel the brunt of tightening, and there was no escape from it. And as long as you could get growth numbers to show you that it's go time, and from about mid-April to August, it looked like it might, and then there was a turn. It didn't quite all happen as expected, for me anyway. The economy, at least at surface level, held up. The numbers looked okay. But of course, yes. Mm-hmm. Of course, yes. It's not, I think, when I say that the PMIs caused the market sell-off, I'm not saying that that a single PMI number caused the market to change its mind. No. It's that what the PMIs showed is the impact of optics and uncertainty, and they give you a trigger for I've been concerned about XYZ thing as an not me personally, but I, Joe investor, have been concerned about XYZ thing for 9 months, and now that I see this data, I think it's go time. That's what it is. Hence the sell-off now and not earlier.
Yeah, I'm with you. It works in hindsight. It works, but I also think
it has to be in hindsight, because you have to see what the price action does with the numbers. That's really the only way, to your point, to calibrate your lens, so that when you see the next thing, you go, okay, I should be looking here and not here for how the machine works.
Right. I think we landed a decent spot there.
Yeah.
I get your point of view. I do understand your point of view. I'm just trying to frame how I'm viewing the world, and I'm not big money by any stretch of the imagination. But I think the way I try to see the world is to ask myself, if I had dumb money, how would I act? What would I do? And I think that's the way I try to see the world. And like, if I think everybody and their mom, go read everybody's end of the year reports from last year, and go read what they wrote about 2025, and go look at how many people expected a bumpy first half of the year,
of course,
or a growth slowdown in the first half of the year. So what I'm saying is, when we get there, you can put all the narrative on it you want to, but like people saw us coming from a mile away, away. Every bank and broker out there that put out something, go read it. Go read it again from November and December, and they all had the same sort of idea that in the first half of the year we'd see an increase of volatility and a growth slowdown, and the market would have to digest that a bit. And we're here, man. And if you think it's all because of, Orange Man is talking tariffs, I think you might be missing part of the story. That's my point.
Well, I mean, no, I don't disagree that what you have here is the meeting of match and gunpowder. The gunpowder was there. It needed a match. I think if you look at what those same banks and those same forecasters were saying at the beginning of 2024, they were saying the same thing. Doom. I was saying the same thing. We're going to have a rough ride in 2024. This is the time when all those rate cuts really got to ramp up, because the rate hikes are going to start to bite like right around now. And in 2024, it didn't happen.
That fiscal impulse. Would you say in hindsight you didn't properly discount? Let me say it through my lens. I think I didn't really understand just how much money was spent in the fiscal impulses, like those bills that we were passing. I think I totally sort of like didn't really break down and conceptualize just how much money that was and what it could do to buoy the economy. I also didn't understand how many levers like Yellen had, to move issuance across the curve, or maybe not even how many tools she had, just like what she would be willing to do. I don't think I gave that enough thought. ideated along the possibilities there. Would you say that's true for you, or do you think you had a pretty firm grasp on the fiscal impulse, just we're a little early? What do you think?
I think my problem wasn't so much the size of the fiscal impulse. It was how much money corporate America locked in at basically no interest when the Fed went full QE and the government rained money on everybody, and corporate America didn't have that money to spend on stuff because there was no activity. Everything was closed. Everybody was at home. Nothing was going on. And so all of these businesses, number one, borrowed ridiculous amounts of capital for nothing, and then saved ridiculous amounts of money. And so I was expecting, borrowing costs are rising. We're going to have to refi all this rollover. But what I didn't count on was that stuff is going to hit the fan a year later, because that's where the refi on the cheap COVID money is. And when I saw, it was really a report from The Economist that said, here is every easing and tightening cycle. In every other tightening cycle since the 1970s, corporates have had to pay more for credit as a consequence of the tightening cycle pretty much right away, except now. Corporates' outlays on servicing debt actually down since the start of the Fed tightening cycle. And it's because they hoarded money during COVID. They haven't felt the pain. And the pain comes in 2025 and in 2026 when that stuff terms out. And I did not give that enough credence. It's not that businesses didn't face higher borrowing costs. It's just they had so much left over in the tank they didn't care. Until, of course, now they do. Because they have to because now they have to roll it over, and GDP, let's say debt to GDP numbers look worse if the GDP is getting hit and you have to roll over at much higher rates. That much more difficult to service.
Let me ask you, so let's go back to risk assets here. So I'm gonna go pick at the stagflation thing again.
Okay.
Some part of me wants to say once you see it in the SEP, it's over.
Yeah. It's like an Economist cover.
Yeah, it's like they're stamping what has already happened. So now you got to look at, okay, that trend is over. Let's look at if it's not slowing growth.
Well, this is judo, right?
Yeah.
This is Fed judo, right?
Yes. So some part of me goes, is that, do you keep playing, do you sort of keep playing that mode of the economy or those chips on the table of slowing growth, rising inflation? Or do you think it's possible we're headed into sort of a different window of time, perhaps slowing growth and slowing inflation?
Yes.
Or disinflation. Do you think you in the next 3 months, keep playing the slowing growth, rising inflation sort of playbook? Or do you think would Ilya Spivak be transitioning into something either a little worse or a little bit better?
I don't buy the rising inflation.
I don't either. I don't
buy the rising inflation.
I don't either.
Nah.
I think it's a story they're trying to spin, because if you're afraid of inflation, they get to hold rates steady for longer.
Yes.
And
yes. And by the way,
I think so too.
And by the way, I don't fault them for it, because their first rule, much as a doctor, is first do no harm.
Mm-hmm.
And they're going to come out and they're going to go, look, we've had 1 month in the last set of CPI numbers where the higher frequency stuff, the annualized 3-month rate, 6-month change, started to come down again. But it was warming up. In September, the markets came back. The Fed was really dovish, and the markets told them, what are you, nuts? No, you're not doing this many cuts. Stop it. And the dollar went on a huge run, and yields went on a huge run. And the Fed is like, oh, well, thank you very much. You talked yourself onto the brink. We leaned into you, and what do you know? You took yourself off the brink. Thank you very much. Fed's been playing this game very well, as we've talked about. They figured out that instead of fighting the market's speculative impulses, you lean in to a level of ridiculousness. The market gets to look at itself in the mirror and go, yeah, you're right. We're kind of ridiculous. We'll stop. And so the market was looking at this already.
That's exactly what he's doing. Every time you go, this is the thing he won't do, or this is the thing the markets want, and you go, he's not going to do that. And then he goes so hard
to the end
into
level. Yeah, he goes, okay. It's sort of like your kid that wants to go outside in cold weather in shorts, and you're like, you know what? Skip the shoes too. Whatever, man. Don't wear a shirt. And your kid goes, okay, Dad's lost his mind. I'm gonna put a jacket on because this is getting weird.
Or that old thing. I don't know. Maybe this is a Soviet parent thing too. But isn't this a thing where if a kid wants to smoke a cigarette, you go, okay, you catch a kid smoking a cigarette or something like that, then you make them smoke the whole pack, and then they get sick.
My
so they never want a
experience
cigarette
was very
again.
simple. So my growing up was very simple. I was demanding my mom give me vodka when I was like 6 years old, and being the brilliant
that checks out.
Yeah. Being the brilliant tactician that she is, she goes and reaches back to like some back shelf for a bottle that's been sitting at room temperature for N number of years, and goes, "You want to try vodka? Go ahead. There you go, buddy.
Skol vodka, son.
Enjoy." And it's like old, warm vodka. It takes you off vodka for the next 10 years. You're like, what is this nonsense? Who are these people that want to consume this? And so,
see, that's old school parenting.
That's right.
The Zoomers are like horrified listening to this. They're like, make them smoke a whole pack. Just vodka for a 6-year-old. Are you guys insane?
Well, with cigarettes, it was simpler. When my mom caught me smoking the first time, she was like, well, at least don't smoke garbage. Jesus, let me buy you a pack of something good.
It's the good stuff.
Yeah. I think I was 13 at the time.
So, in the rest of the world, do you ever buy a pack of, I'm not a cigarette smoker, but
I used to be one, but I quit ages ago.
Oh, did you? I've seen in like Canada and then in Singapore, I see the packs of cigarettes. Bro, they go out of their way.
They go big
to put disgusting images.
It's a horror show on there. It's a horror show. That like, would you like to see a really messed up lung? Because we have it for you in sharp relief.
Now think about, like, you've got them all on display behind, the person at the 7-Eleven, just a bunch of like horrific images, like, and you're like, give me the.
Yeah.
It's
stills from Saw, just behind every convenience store clerk. Yeah. In Australia, it's really crazy.
The reason I asked that question, I think. Do you play the slowing growth, rising inflation? Do you take the Fed's word for it, and do you keep playing that playbook for the next 3 months? The reason I ask is because it will probably inform how you think about metals here.
Yeah.
So I'm curious.
I don't buy the inflation piece. I buy the gold. I buy the slowdown in growth. I don't buy that it's that it's inflationary. I think inflation comes with the growth, and I think they both go down.
I actually think so too, dude, which is scary. So then what do? You
buy bonds and you sell dollars, and you look for stocks to give you an opportunity to short them in a very classic kind of earnings are going to be lower. Refi has come for corporates this year and next. Nobody's saying it's a catastrophe, but they're not going to be as freewheeling. They're going to be stingier on hiring, on investment, on everything. It need not be a crisis, but people seem to forget that you can have just a regular recession. You don't have to have an 2008 crisis. You don't have to have COVID. You can just have a recession. I think if you look at what's going on now, if you take the administration at face value and you go, okay, as I do, I don't really tear my hair out as I see all of this inconsistency in their actions. To me, that's tactics.
Correct.
It's meant that way.
Mm-hmm.
I think for markets, the problem is not that it's meant that way. It's that if consumers stop spending and businesses retrench, then the strategy isn't working. And you want policymakers to be responsive, or at least to come tell you why you should give them space and patience. It needs to make sense. And when they see it in the confidence numbers, they go, okay, so are you going to now address this for the folks? And they don't do an adequate job of that. And so the data keeps showing concerns, and the markets go, okay, make it make sense. It's all good if it's forecastable. It just needs to be forecastable. Just give us something that's forecastable. And I think what you're going to end up seeing now is growth is going to retrench, consumption is going to retrench. I think inflation is coming down with all of that. So I think you just bet on a more dovish Fed. That they were resistant this time tells you they probably are going to have enough data to lean in harder when they meet in May. And then by June, you get a new SEP, and they might already be cutting by then.
Yeah, it's sort of interesting. They take down growth and they increase inflation. We've been making this joke that they want to keep the risk balanced, you know? So if you're going to take down growth and you don't do anything with inflation, you're not balanced. You're leaning to one direction.
Judo.
So an interesting sort of judo move. Yeah, you raise inflation expectations and everyone's like, what? This is stagflationary. Meanwhile, inflation expectations, as implied by market pricing, has not
break-evens are down
from yesterday. Exactly.
Well, and Powell said this, right? And this is why it's a growth scare. Powell came out and was like, listen, I don't know what to tell you. You look at some measures of inflation, they're up. You look at other measures of inflation, they're down. Look at the break-evens. That he said break-evens definitely gave me a little bit of a pat on the back. I love the break-evens. They're my favorite indicator for inflation expectations. I'm like, yeah, Jay Powell, talk about those break-evens. That's right. He was like, the mood in the markets is yields down, dollar down, break evens down. It's a growth slowdown.
That's still a supportive environment for gold, is it not?
Yes. Yes, it is. Yes, it is. I think
it's less of a supportive environment for silver. So one of two things could happen here. Both a rising tide lifts both ships in terms of gold and silver, or we see the gold-silver ratio potentially rise. So take more silver to buy a bar of gold. That could happen here. Would you expect something like that? Like what? Or do you not want to take a guess on something like that? Like how would you play? It seems like supportive environment for gold. What about silver is my question.
I think silver, there's a reason why silver has been underperforming, and I think it's because silver has this added element of risk sensitivity by virtue of being less liquid, more cyclical, because it has an industrial use element that gold doesn't. And so it has a level of sensitivity to economic activity that gold doesn't to the same extent. And so for gold, it's very tenuous. It's like, well, if economic activity is down, then maybe spending is down, then maybe people buy less gold stuff. But that is such a small influence on the price of gold that nobody really cares. Grills. Yeah, nobody really should care that, like, well, it's less gold grills and more like lavish Indian weddings. And like lavish
I bet you've worn a grill before. Have you worn a grill before?
I have not.
Bullshit.
No, I have not. Not a grill. I'm from the West Coast in the 90s. That was not we were not on that time.
Chris told
Our thing was Dickies and Ben Davis jackets.
Chris told me a story yesterday. You and him were in Vegas smoking Black and Milds. Black and Milds. Definitely. And damn, what were you guys talking? I forget the topic of conversation. It was something. Oh, he was asking about crypto, and you said, "I don't like it. It's gambling." And he loved the irony of you two being in Vegas.
Yeah. No, I mean, I'm perfectly okay setting a few bucks on fire in Vegas because I'm hanging out with a group of people that want to do that. I would never go play in Vegas myself. I'm just not interested.
Oh, I see what you're saying. I'm that way only with poker. I don't like playing poker in a casino. I love playing poker house games. I don't love, because I grew up behind the screen, so I feel like my physical presence, like there's too many tells in it. So casino I don't love, but I like blackjack and other games, like table games like that. I'll play in a casino. But here's my question to you. You have negative edge in the casino. Mm-hmm. And while on the long run, you might feel that Bitcoin, has no tangible value, it doesn't mean that you can't make money and that you have 50-50 edge to the marketplace. So why not trade it at all? Because you don't even swing this thing at all, which I don't get.
I don't. I think it's really difficult to have a two-way market here, even more difficult than it is in stocks. Stocks are notoriously biased higher. And if you have a bearish view, I can tell you from personal experience, Godspeed, because you are fighting a market that does not want to go your way, but for if it really gets spooked, which is why last year and this year, I'm always doing it as verticals. I'm always keeping my risk very small. I'm keeping it very risk defined. I don't take a position unless I get a 2-to-1 risk reward locked in by the vertical, thereabout. So I'm very careful. I make sure I don't fight a market that doesn't want to go my way, because I am inherently setting myself up for a low probability thing, but which I expect will have a high asymmetric payout if the markets go nuts. And needless to say, so far this year, it's working. When I look at Bitcoin, you can't short it in any kind of a reasonable way. What is the vehicle to short it? It's very difficult to get any kind of reasonable risk reward on options. You're not going to naked short it. If you have a way to bet against it, what you're really betting against is risk sentiment, and there are more liquid ways and better sized ways and better risk reward ways of doing it. Since I don't want to be long structurally.
I agree with everything except risk reward. I think there are asymmetric opportunities in Bitcoin given the high level of volatility. And I think this is less true lately because it has been highly correlated to NASDAQ, but there have been times when you get a lack of correlation with other assets. So
I agree.
You get non-correlated volatility.
No, I agree with you.
But when correlations go up, honestly, it's just a high beta NASDAQ. So I don't know.
I agree with you there. What I mean when I say risk reward is, I mean, it is very difficult, unless you have a really big account, to structure even a put vertical where your risk is locked up, where your max loss is something that's like 1% of equity, 2% of equity. And you can go, okay, well, that's like a normal amount to risk. If I'm risking 1 or 2% of equity, looking to make 2 to 4% of equity, okay, yeah, cool. I can do that. I can do that in stocks. I can do it in commodities. I can do it in currencies. You cannot do it in any Bitcoin tracking instrument. You basically have to sign up to take a 3 to 5% hit as a baseline entry level to wanting to short it. Not for me.
Yeah. The spreads are still too wide as well.
Yeah.
Absolute beginner in the chat says, what did he? There's something. Oh, Ilya works for the Fed. The evidence is there.
I wish.
Ilya.
I wish. Will somebody?
You do, huh? Is that your dream job?
Will somebody? No. I like the hands-on part. I had this reckoning to make on my way out of college, because for me, as a student of economics and international relations, it was either the hands-on bit or the academic bit, and the Fed wants the academic, and I wanted risk in markets. So I picked the other side.
Yeah, but you still got one foot over there. Let me tell you, you've got one ideological foot over there in the door in case you ever need to make the switch. Ilya Spivak, it's always a pleasure. I wish we could go on a little bit longer, but the production team has got a hard stop at 6:30 because they have some great work to do in improving the network on a day in and day out basis. So Ilya, if the people want more from you, and they should, especially in uncertain times, tell them where they can go, my friend.
As ever, I am all over the network. Overtime, and Macro Money are there Monday through Thursday. We're here usually on Tuesday. It's a special week that we're here on Wednesday, but we're here once a week for this excellent show. I am with you for Tom and his musings at the opening of the markets for First Call on Sundays. I'm writing for the News and Insights portion of tastylive.com, where all of this stuff is reiterated over and over again. I am also commenting on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you want to get into a back and forth, I'm all for it.
Can I ask you a question? How come you're not on True Social?
I don't really think that that's been something that I am interested in following. I think it's very one-sided. The reason I'm on Blue Sky
isn't?
No. Mm-hmm. I think being on both.
I'm not
Twitter
on True Social either, because I just don't think there's enough people there. But I'm not on Blue Sky for a similar reason.
Yeah.
But also because of I don't love the fact that we're separating out and we're
I don't
going
like that
into
either.
echo chambers. I think that's very dangerous.
I agree.
Anyways, Ilya Spivak, you're a gentleman, you're a scholar. Thanks for letting me I don't know. I say spar, but really, like, I was watching this clip the other day, which was like this dude had been boxing for 20 years, and this kid who just started, and this dude just was running circles around, just bing, bing, bing.
Yeah.
And I feel like that's what our spars are. It's not like an evenly matched sparring session. It's a guy who's sort of a newbie in the ring, and this experienced guy going, all right, whippersnapper, I'll show you a thing or two. But you're a gentleman.
I tell you what, though,
the
great thing about this show is that we have the space and we have the appetite to have these conversations, other than just either partisan hair on fire, pick your side, or markets up or markets down.
Oh, I can't stand either of those.
I can't stand either of them.
Ilya Spivak, I will see you back here on Sunday, my friend. For the rest of you, I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Till then, peace.
Peace.